Welcome back. We're now going to talk about investment strategies for generating income in retirement. And David, it's a whole lot different again than it used to be, just like the changing face of retirement. Maybe talk about, in a nutshell.
Completely.
Yeah,
in a nutshell, I think number one, you think of interest rates, you could just put your money in a bond or a GIC and just stick it in there and keep it there for 10
Who buys
years.
those now?
Yeah, well, it's pretty challenging. You've got to get, and so as a result of that, they've come up with more and more alternatives and created synthetic products, all sorts of things to add to what people can generate income from.
Yeah.
And as a result of that, retirees have sort of moved out the risk scale. Even in a bond, they've gone from a government bond to a corporate bond, and then up to a high yield bond.
Okay.
And so
is that a little more risky though?
Yeah, they're more risky, right? They're less liquid. They're generally pay higher interest rates.
Argentinian government bonds.
And the reason why they pay higher interest rates is because there's more risk attached.
For sure,
Yeah.
What do you see, Jeff, in terms of, in a nutshell, what the differences are?
Well, they used to have all these rules of thumb built around how much fixed income you should own. So, 100 minus your age, or your age minus 10. And predictably, it would always suggest that as you got older,
Get more conservative.
you got more and more conservative. But what happens today is that you can't afford to be more conservative because rates are, a 10-year Government of Canada bond is at 1%. A 10-year U.S. Treasury is 130, 140. So people are being forced into the market or into riskier investments, like you're saying, in order to generate a reasonable amount of cash flow. So now they're looking at stock dividends, preferred shares, hybrids, synthetic things.
Yeah, and the worst part of that is people are becoming more and more educated about, which I think is a great thing, but sometimes too much information.
Blame it on the
dangerous,
internet.
right? It can be dangerous, right?
Yeah.
And then in addition to that, you've got, as I mentioned before, more and more technology improvements and access to information, and you're bombarded, right, with stuff, and it just creates a stressful environment for
In the
a lot
old
of people.
days, it was really just kind of the wealthier people that had a broker, for example, and bought stocks, and then mutual funds came out, right? And it enabled pretty much anyone to buy stocks.
Exactly.
Now we have ETFs,
Right.
a little more refined and a little less, fees is the big reason why people like them.
Yeah.
What do you see sort of going the next step from there, for example? What kinds
Well,
of things?
you get a do-it-yourself approach, so you can use like a discount brokerage where you execute all your stocks, bond, security transactions, robo-advisors. Robo-advisors.
I saw one they were trying to bring out in the States, and it was partial share ownership. And one of the companies was called Mosaic. And basically what you did was you could go in there with $5,000. And they had all these portfolios that were either thematic or, like they could be green or environmentally friendly, or there was as many different opinions out there. You could create these portfolios, and they're all posted. So then you could select that portfolio and put your $4,000 in. You'd own little part pieces of all these shares, so you owned the portfolio, and people were connecting online and discussing the value of it. So it's even, it's certainly not at the forefront of all the investing now, but it's another one of those things that's changing the way it looks.
Yeah, and actually, the addition to what I meant to mention was the addition to ETFs. They're coming out with, typically they've been passive strategies where you just buy and hold an index, as an example. Now they've got thousands of different types of ETFs, but they've also got different active strategies, like a smart beta strategy, or those sorts of things that that add more of an active component to it that they traditionally didn't have. So there's lots of choice out there for for people.
I want to talk a little bit about the environment we're in today, Jeff. The low interest environment. This is completely foreign to our parents, for example.
Absolutely.
They've never seen anything like this, especially in the early '80s. So talk about what that means and how that's changing people's way to invest.
Well, it's certainly forcing them to be riskier. But risk is one of those terms that, let's say all you did was buy a bond and you earned 1%. Well, inflation's running at least 2%. You're paying tax on it. So in fact, you're losing money every year. So is that riskier than owning a number of different shares in a company, earning dividends, and over time earning 3, 4, 5, 6%? So we're having to rewrite the definition of risk.
And I want to talk about the danger of deflation. I mean, that's really scary, isn't it, for everybody?
Yeah,
I mean,
yeah.
Japan's been experiencing something close to that for 30 years, it seems. I want to talk about that. When a consumer thinks that the product is going to be cheaper tomorrow than it is today, they might hold off on buying it, and that just drives the whole economy down. Stock
Yeah.
markets do not do well in deflationary periods. Are you concerned about that? I mean, could we have that? We've already seen some banks in Europe now.
Negative interest rates,
Negative,
right?
yeah.
So, I mean, deflation is definitely a risk, and on the converse side, inflation. They've talked about, significant costs, increasing costs throughout your retirement. So, inflation and taxes and those sorts of things all are costs, but one of the things that I think we're seeing new things come into play. So if you retired 20 years ago, and you were paying for your standard landline telephone, now you have an additional cell phone bill that wasn't in play
And
10 years ago. So those are things that even if you do have a deflationary environment where things become cheaper and you have a slowing growth or negative growth type environment.
What can you invest in a deflationary environment? Is there anything that's a good investment in that? Cash is king.
Cash is always good, right?
Not gold.
But stocks will tend to do well. In most. I mean, they go through their ups and downs, right? But a company, perceivably, the purpose behind a company is to grow. And so, assuming that the world is going to continue to grow, an equity or a company should continue to grow despite a deflationary environment.
One thing they talk about, the economists will say, is in a prolonged period of low interest rates, eventually you're going to have inflation, right?
Yeah, that's right.
That hasn't happened. It's been since 8 years now since you had a crash. That hasn't happened.
I think part of the underlying, part of the underlying thought on that though is that the economy hasn't grown as quickly or as strongly as it traditionally did as well, which would push you into an inflationary area. You've got a 5% employment rate in the U.S. unemployment rate, but how many of those people are underemployed, working part-time, making less money? So, it's sort of like if you look right now, the companies that are doing extremely well are luxury goods. BMW, Mercedes, Louis Vuitton, all of that upper end, it continues to do well and make money.
A couple of things. There's been a structural change. So, there's been a divide, between the rich and the poor. Wider divide. But one of the things that has happened is that in that structural change, there's been a change towards more of a service-based, a change in the type of jobs that people are doing, right? So with that, you've got people that are having more money at the end of the day, but not necessarily, it's not circulating in the economy. So the government, made a move to create more money in the economy and
quantitative easing and all that.
That's right, to drive
Printing money,
spending,
basically, right?
To drive spending, and that hasn't happened because even though there is more money, it isn't being recirculated in the economy, and that's why you've got a slowing growth, environment.
And that's what they learned in Japan was they keep lowering the rates, thinking they're going to stimulate the economy, but if people are nervous, they're not spending money.
A part of that is demographics too, right? And so you've got aging economy that's not necessarily as productive in this end or in the,
they're a little bit ahead of us in that regard. But
Yeah,
we're starting
that's
to get
right.
to that level as well. I want to talk a little bit about, we've seen the house price. There is inflation in house prices. It's been going up a lot since 2008. Now, what happens if there's a crash, for example? It could happen, especially in Vancouver, for Toronto, for example. The Bank of Canada can't really lower interest rates that much more, right? There's not a lot of room there.
Yeah.
Is that what would happen, I guess?
Well, I mean, we had one in the 80s. It was,
But that was high interest rates, right?
Yeah, with high interest rates, they had room to
Yeah,
come
lots
down.
of room to come down.
So
Now they
you're
don't
right,
have
so
that.
you're right. Now it's, I don't know. It's interesting. You know those things you get, like you'll get those, back on your birthday on this day. We got an email through that was somebody just turned 50. And the average price of a house in Kelowna 50 years ago was $14,000. The average household income was $7,500.
So you only needed 2 years to pay off a house, technically.
You're right, technically.
Yeah.
And yet, well, today, I mean, what's average income? $75,000, and the average price of a house in Kelowna is $500 plus.
600. So yeah, so you need a lot more years of income to pay it off.
So what's let's just talk about that, because something interesting happened last month, and we had an increase in prices, I think about 5% over a year ago in August in Vancouver. But for the first time, you've seen a slowing in sales of prices from July to August.
Thanks to the foreign buyers tax, right?
The foreign buyers tax has really impacted it. Yeah. So I think a lot of what has driven, I'm maybe speculating a little bit, but a lot of that has driven real estate prices in Vancouver is that it's a world real estate market. That's right, and so their competitors are larger cities, but they also have a lot of influx from foreign buyers coming in, and because I don't think that necessarily incomes have increased enough to justify that type of
no, for sure. I want to talk about one more thing.
Okay,
running out of time, but the houses a lot of people using for income in their investment is their real estate. I mean, this is a generation that's seen a huge increase in the value of their home. I mean, is that what you're seeing? Your clients are using the home equity, for example, to fund their retirement?
Well, this
or sell a home in Vancouver, buy one.
That's exactly what I was going to say. Is that I just saw in the just the headlines in the paper was Okanagan's to benefit from Vancouver's sale of property and that sort of thing, and people moving to the Okanagan. So we do see quite a few people retiring here. And they've either, maybe sold in Vancouver or Calgary or elsewhere. If it's the prairies, I mean, they usually have to kind of back up a little bit more, so it's a little bit more of a challenge. But yeah, I think we benefit in this area as a result of it, and a lot of people do take some money off the table from real estate
to fund their retirement.
Fund their retirement, right?
Sure.
Now that being said, there are, as an alternative, some people are into rental income, and so they have rental properties. Now that creates another whole sort of job for you to, make sure you're taking care of your tenants and doing all those sorts of things.
More stress in retirement.
A little more stress, but it is a viable investment option to fund part of your retirement, right?
Okay, Jeff and David, thanks for joining us today. Jeff, if people want more information from you guys, where do they go?
Yourlifeyourplan.ca.